Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's going on in investment markets and what to look out for in the days and weeks ahead. Now, since the last show, the S&P 500 in America continues to push to new all-time highs. We get the occasional pullback, but the trajectory is definitely upwards, and that's being largely driven by technology stocks. If you look at the Nasdaq 100, that's also been setting new all-time highs. So the S&P 500 is now above 3,500, and as I make this video, it's around 3,580. So technology stocks are still doing a lot of the heavy lifting, although there are signs that breadth in the market is improving. That means there are more stocks actually participating in the rally and fewer stocks actually declining. So the more that participate in the rally, the more sustainable it should be in the long term. We don't just want tech stocks doing all the heavy lifting, but at the moment technology stocks are doing most of the lifting, and we've seen some crazy moves again in particular stock. So take Tesla, for example. If you remember last week, I talked about how its share price has gone up 40% in 8 days. Well, try it going up 12% in 1 day on the 1st of September, and then tumbled about 13% the next day. And that was triggered, the rally was triggered this week by the stock split that the company had announced in August actually taking shape. And stock splits are generally meant to, they're seen as positive for stock prices because they allow, theoretically, smaller investors to be able to buy the stock because they actually they will increase the number of shares in existence while maintaining the market cap of the company. So Apple also did the same. So we saw not such aggressive moves in the share price of Apple this week, but we saw a 4% bounce on the 1st of September, only for that to pull back the very next day. So we are seeing some crazy moves. Go on your app on your phone and look at your stock app. Look at Tesla's share price this year. So if you look at it from the March low, the stock price has actually rallied 500%. Now, if you were to overlay that on something like Bitcoin in its heyday when it was pushing to crazy highs, you could argue it doesn't look dissimilar. It doesn't mean to say that Tesla is necessarily a bubble about to burst, but it does increasingly look very stretched and could potentially be one. It's being inflated by the Federal Reserve and its low interest rates and money printing, but it does look like maybe one day, could it be one of those case studies in a boom and bust, a bubble and a burst in the future? Now, looking over to the FTSE 100 in the UK, that continues to lag US stock markets. It's actually pulled back below 6,000, as I mentioned last week, but it actually fell by the most it had done in 3 months on a single day. That was in the last week. And we fell down towards 5,829. So it's rebounded since, but we're still below that 6,000 level, and it's still lagging US markets. Now, it isn't just US markets that are pushing to new all-time highs. We've seen little bits in certain European markets, and that's meant that the All Countries World Index has also pushed to new all-time highs. Of course, it's heavily influenced by US stocks. They make up the largest portion of that particular index. But what it means is stock markets are still pushing higher. There's momentum. The momentum seems to be building. How far it can keep going, could we keep seeing new all-time highs? We'll have to wait and see. But on their own, all-time highs are a positive, bullish indicator. So the more all-time highs you have, the more likely you are to get the next one. I once did a piece of 80/20 investor research on that. All-time highs are not to be feared necessarily. They can be indicators of further to come, but we'll have to wait and see because, of course, we've got the US election coming up in the coming months. Now, if we jump over to different asset classes, bonds have actually rallied this week. So if you think about the 10-year US Treasury yield, last week I mentioned it was around about 0.72 it was pushing towards on the 10-year US Treasury. That was a key level that I mentioned that we had to keep an eye on. If we broke above that, we could easily get to higher levels above 0.75. We did in fact hit 0.75. So don't forget, when yields go up on a bond, it means the price of the bond falls. So any holdings you have in bonds lose value. Well, this week that trend has reversed, and so we've seen bonds start to pick up in price, which means the yields have fallen. On the 10-year US Treasury, the yield is back down towards about 0.65. We've seen a similar pattern on the 10-year gilt, in the UK. So bonds have again rallied. So those 100-day trends that I've been talking about in recent shows, whether it's the Nasdaq, whether it's the S&P 500, whether it's the gold price, or indeed the government bonds in the US or the UK, have been respected. We keep pulling back and then they bounce. But on gold, the price has tried to break back above the 2000 level and has struggled, but it's pulled back and currently sits around $1,936 per ounce. Now, if you look at that uptrend line, that 100-day uptrend line that I've been talking about on various asset classes, it's holding above that. We need to see it bounce from here again, as it did last week when it was testing this level, if that uptrend is to be respected. Now, one of the big influencers on the whole market is the strength of the US dollar, and one of the indices that I'm watching quite closely is the US dollar index. Now, the US dollar index is a measure of the strength of the dollar against a basket of different currencies around the world. And if you get your stock app and you search for the US dollar index, I think the code is something odd like DXNYB. That's a very good index to keep an eye on at the moment, because so much is entwined with the strength of the dollar. The reason the gold is doing so well is influenced by the weakness of the US dollar, which obviously is a result of all that easy monetary policy that the US Federal Reserve is pushing out there, all that money printing and low interest rates. But the low value of the dollar, the weakening dollar, is also boosting US stocks, particularly US tech stocks. So the US dollar is having a huge influence on markets. And as I've mentioned, if we see the dollar suddenly rally, we could see a lot of these momentum trades that have been doing very well in the last 6 months, suddenly unwind. Now, at the moment, that index is around about 93. If we go below 92.5, that could show signs of further weakness. But having said that, we've seen some interesting technical analysis this week, some rebounds. I won't get into candlesticks. I've mentioned them before on the Sunday podcast if you want to go back and have a listen. But we've seen some signs that we could at least be in for a short-term bounce in the dollar. So keep an eye on that. And we may therefore see some increased volatility in markets, particularly equity markets. Now, I want to give you another couple of indices that I'm also watching at the moment. And one of them is the VIX, which is often called the fear gauge in America. And it's a measure of volatility. And that number at the moment is around about 26. But what's interesting, if you look at the chart over the short term and to the longer term, whenever the VIX has broken above its 20-day moving average, which it has just done because its 20-day moving average is now around about 23.3, whenever it's broken above that 20-day moving average, the VIX has tended to explode to the upside. And that means that the level of fear in the market increases, which is therefore generally negative for equity. So keep an eye on that in the short term. It's something to bear in mind, particularly as we approach that US election in November. And if you are a regular listener of the show, you will know I love a correlation between asset classes. Now, one of the correlations that I'm looking at the moment is between the Kospi, which is the South Korean equity market index, and the Nasdaq 100. Now, South Korea is a country that is one of the biggest innovators when it comes to technology, and the Kospi correlation to the Nasdaq 100 is almost perfect. And when I say perfect, a correlation coefficient, which is a statistical measure of a correlation, can be between 1 and -1, and 1 is a perfect correlation, and the two indices have a correlation of 0.98. What that means is whenever the Kospi moves up by a point, the Nasdaq tends to do the same. And if you move in the opposite direction, the Kospi falls and the Nasdaq could do the same, and vice versa. So it's not perfect, but over the last 6 months, that correlation has tightened. But what we've seen in the last 2 weeks is the two indices start to diverge. So the Nasdaq keeps pushing to new highs, but the Kospi is starting to flatline. So we're starting to get this divergence. And when that happens, usually we've seen, or certainly in the last 6 months, is one of them snap back, whether it's to play catch up or the other one to fall. So will the Nasdaq pull back? Is it an omen that we're going to get a pullback on the Nasdaq 100. And if we do, therefore, that could be a negative sign for not only US equities, but global equities more widely. So the dollar remains the key driver of markets at the moment, particularly as the US Federal Reserve didn't bring out any surprises at last week's Jackson Hole meeting that I mentioned in last week's show. So at the moment, we are still waiting to see what happens in the coming weeks and months in the lead up to that US election, but keep an eye on volatility. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email, damien@moneytothemasses.com. Twitter is moneytothemasses with the number 2. We're on Instagram, Facebook, and of course, don't forget to subscribe to our YouTube channel.